And I think this cycle, we have Bitcoin treasury companies, they might be a little bit frothy. And now we have digital assets treasury companies, even frothier. You might call this weakness, but I would say next to, say, the last cycle, it's stronger. And maybe some people think the drawdowns will be less. But I think when you think about it in terms of where the world economy sits, I think we'll get this 4-year cycle again. I think the drawdowns will be this time pulled down by the world macro markets. And Bitcoin being quite sensitive to liquidity is got a lot more pull down than typical markets. So yeah, I could see an 80% drawdown again. No one really knows, but it's not out of the question. In fact, I think it's probable.
Every conversation about Bitcoin eventually circles back to the 4-year cycle. It's become one of those ideas everyone repeats like gospel. Willy Woo points out that while the players change, new investors, new products, different macro setups, the rhythm has stayed roughly intact. The halving has been the anchor slashing new supply and forcing a revaluation. But that effect is softening. With Bitcoin's inflation rate now lower than gold's, each halving matters less than the one before. The more powerful driver, Woo argues, may be the liquidity cycle. When central banks slash rates and pump money into the system, risk assets run. When they tighten, liquidity vanishes and markets falter. Those cycles tend to line up at about 4 years as well. That overlap explains why Bitcoin keeps following a pattern that looks eerily consistent despite new conditions. Layered on top of both is the longer business cycle, more like a decade in length, though irregular. The last deep downturn was the 2008 financial crisis. COVID rattled the system too, but massive money printing papered over much of the damage. If we are entering another genuine downturn now, Woo warns Bitcoin won't escape the drag. Even if the crypto ecosystem is stronger than in past bear markets, macro forces could weigh heavier this time. So while halvings built the legend of Bitcoin cycle, it may be liquidity and the broader economy that determine how the next chapter unfolds. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The 4-year cycle is kind of a cliche within our industry because it has been for 4-year cycles since the beginning. And, if you look at each cycle and you break it down, each cycle has been different. It's been different dynamics, different investors, different instruments, and the structure of the cycle has changed a lot, yet we're still being on these 4-year cycles. One of the things with Bitcoin is that we do have this 4-year halvings, right? And that is up to now been quite reliable as, a supply shock, which is an impulse of, when you have the new supply rate coming down, you get this sort of impulse and the whole system has to rebalance. Presently, that force is waning, getting smaller because the inflation rate of Bitcoin now is half of that of gold. I think it's like 0.8% or something per year. So as we go into future halvings, that's going to dwindle. What some people might not realize is that we have another cycle called the liquidity cycle, which is doing, it's just the resonance that central banks print their money at. There's times where money is plentiful when they drop interest rates and other times where they tighten up. And historically, that's been on 4 years. And I think it's the superposition of both of these waves that have created our 4-year cycles. Now, there's this other cycle called a business downturn cycle, and that tends to be every 10 years, but it's not that, you won't set a clock to it. Let's say the last proper one we had was the world financial crisis in 2008. You could say COVID was one, but that was very, very, a flash in a pan, very, very quick. And, central banks printed their way out of that very quickly. And so I think the economic shape of the economy is heading for a downturn. If that is confirmed, then I think even though the weakness in our industry, let's say the infrastructure, the types of investments that are being made, anything like what we saw in the last bear market, with the likes of Lunatera blowing up, testing the weaknesses in the entire ecosystem, Genesis Trading blowing up, Alameda, FTX, there was this grayscale. The whole thing so had a sort of a domino effect of all the weakness points being tested. And I think this cycle, we have Bitcoin treasury companies, they might be a little bit frothy, and now we have digital assets, treasury companies, even frothier. You might call this weakness, but I would say next to, say, the last cycle, it's stronger, and maybe some people think the drawdowns will be less. But I think when you think about it in terms of where the world economy sits, I think we'll get this 4-year cycle again. I think the drawdowns will be this time pulled down by the world macro markets. And Bitcoin being quite sensitive to liquidity is got a lot more to pull down than typical markets. So yeah, I could see an 80% drawdown again. No one really knows, but it's like, yeah, it's not out of the question. In fact, I think it's probable. In the treasury companies, we do need to see will they be liquidated. Something like MicroStrategy, which has been using now 8 to 12 year up debt, meaning if your price is dropping into a point where you'd normally be liquidated, well, you've got 8 to 12 years for the price to recover to a point before you have to, sell your Bitcoin to pay the debt holders their capital back. That's very safe. We're looking 10 to 12 years out of Bitcoin. Will it climb above the current price? So I think MicroStrategy is very robust around that, and the latest way they're doing it is with preferred stock, where there's not even a debt instrument on it. And so I think that's okay. There's been a lot of copycats that are trying different structures. Metaplanet, I think Metaplanet could be liquidated if they time the market wrong and end up with a big bag of debt and can't sell through it to pay it off if the market turns. And some of the treasury companies are using 4-year debt and so forth. So we need to really see, it's very individual, and that's the Bitcoin treasury companies. And there's a whole host of, Ethereum, BNB, a whole bunch of digital assets that are now starting to roll out. And we know those assets pull back often above 90%, 95% in a bear market. So
the idea of Bitcoin as prime collateral is no longer a fantasy. Willy Woo notes that hedge funds and institutions are already lending billions against it, building the rails for a new credit market. Even U.S. housing giants Fannie Mae and Freddie Mac have started weighing Bitcoin when assessing borrower balance sheets. That's a remarkable turn. Bitcoin is moving from speculative asset to recognized collateral, a role traditionally reserved for treasuries and real estate. The logic is straightforward. Fiat currency keeps losing value, while Bitcoin with its fixed supply offers a stronger long-term foundation. As it scales, the network effect only deepens, making it harder for lenders and markets to ignore. But Wu cautions against assuming the path is clear. The larger Bitcoin grows, the more it confronts the ultimate gatekeepers, central banks. And history doesn't suggest they'll quietly cede ground. In the 1930s, the U.S. confiscated private gold holdings. Later, Nixon closed the gold window to halt convertibility into dollars. Each time the state acted decisively when monetary authority was challenged. Bitcoin could trigger the same reaction if it becomes too dominant. That's the paradox. Bitcoin's rise as pristine collateral brings both enormous opportunity and political risk. Let's get back to the interview.
It's certainly, there's a lot of value to having a big bag of Bitcoin, right? And there's two paths with that. Do you want yield on Bitcoin, where you use it as collateral so that you can do some amount of yield generation? Typically, that might mean trading around markets using it as collateral. And the other way of using your Bitcoin, so that's as I got some Bitcoin, I want more Bitcoin, by climbing up the risk curve, because you're trading now, and you're giving your Bitcoin onto people to trade it, and it's sitting on potentially not robust exchanges. So you're taking extra risk. The other way of using Bitcoin, again, as collateral, is to front it and borrow against it. So these are for the investors that want to, follow the pattern of the wealthy, which is never sell your asset and use your asset as collateral so you can borrow, see it to live your life, which is debasing towards zero. And so those are the two uses. I think that it's already started, that there's an infrastructure and an industry developing using Bitcoin as collateral. And we've seen Cantor Fitzgerald reserve $2 billion of liquidity, US dollars, to lend to Bitcoiners. Freddie Mac, Fannie Mae, who dictate a lot of the lending market in the US, are now accepting Bitcoin as a balance sheet item for a borrower when assessing risk. And so these steps are starting to happen, and the TradFi world is now starting to recognize that this is an asset, and it serves a very good purpose as collateral. So yeah, I totally see a lot of use for this. I don't know the complexities of what a public company may and may not be able to do with Wall Street. I can see there's great value in it. I also see there's great risk for Bitcoin as an asset, because if you think about Bitcoin getting larger and larger and larger, who is the competitor? And that is the central banks that print fiat. And so it does mean there is a power shift, and during a power shift, we've seen all sorts of things happen. A nationalization of an asset such as gold in the 20th century, and converting that into fiat by closing the redeemability of paper notes for gold has happened before. And so I think it's a very real risk down the track. It might not be this rosy future where we have a great treasury company. It's a Bitcoin treasury company, and it can do all of this great stuff with the asset. We need to think about, where does that put the state, and what are their options, and what are the risks around that. Bitcoin's got one thing, a number of things going for it, but the one I'll focus on this discussion here is that Bitcoin can travel across the world at the speed of light, right? So it is a good medium of exchange. It's just, other than the price volatility, and gold wasn't, because it's very hard to ship a gold bar across the world to settle trade. And so we needed a paper layer 2 called notes that are redeemable for gold. And that means that the supply gets centralized. Let's call it Fort Knox. And it's the one entity, a nation state's saying whether or not that gets redeemed, right? So that became a very fragile structure. If you look at 6,000 years of gold and silver as money, medium of exchange, and the store of value, just holding it, the value of holding it, were united until the world got complex with the Industrial Revolution, and we needed to separate the medium of exchange, because shipping gold, lumps of gold, does not work. But Bitcoin, you can have this with the medium of exchange. And once you get that, the whole thing becomes robust. It's very hard to tear the medium of exchange out from the unified money in there, whereas gold was not capable of doing that. So that's the path we want to get to, and we want to get to that end goal without having big pockets of the supply under a digital Fort Knox.
What stands out now is how one digital network is quietly taking a seat at the same table as the most established pillars of global finance. For years, it was dismissed as speculation, a plaything of retail traders and risk takers. Yet the shift is unmistakable. Major lenders, funds, and even government-linked institutions are beginning to acknowledge its staying power. That recognition does more than add legitimacy, it reshapes the foundation of credit itself. Assets once thought untouchable by regulators are now woven into balance sheets, and in the process, a new kind of monetary hierarchy is forming. But history reminds us that when alternative stores of value grow, too influential governments often step in to reassert control. The tension ahead is whether this experiment in decentralized strength can expand without sparking the kind of pushback that rewrote the rules of money in past generations. If credit markets continue to adapt around this digital asset, will it evolve into a permanent pillar of finance, or is it destined to face the same clampdowns that crushed earlier monetary challengers? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.